Good morning. It's Thursday, April 24th. Thanks for joining me. I'm Philip Streible, Chief Market Strategist at Blue Line Futures. So the dip buyers are back in the gold market, and this comes after gold's biggest one-day drop since November. Probably right on that election night. I believe we also had some large drops as well during COVID as we were kind of coming out of the pandemic and markets were starting to pivot here towards a risk on sentiment in the equity markets. Now, looking at the overnight moves in the markets, the global rally in equities, it did stall, but we are coming well off our lowest levels with U.S. equities turning positive as of this recording. Investors, they scaled back their expectations for quick progress here between the U.S. and China with regards to the trade war. The U.S. futures, they fell here yesterday and they kind of scaled back here after that explosive rally we saw. This comes after Treasury Secretary Scott Bessent. He casted doubts on a timely resolution of the trade war, while Beijing said the two sides aren't in talks whatsoever. So it's kind of interesting. We're hearing the administration say one thing, we're hearing China say something completely different. So you saw stocks in Europe, they dropped while Asian equities snapped a 5-day winning streak. The dollar index had also weakened as uncertainty boosted demand here for the Swiss franc, the Japanese yen, and of course the gold market. So looking at China, China demands that the U.S. revoke all unilateral tariffs and says there are no talks on reaching a trade deal. China wants to see several steps from the U.S. administration before agreeing on the trade talks. Now, something that I'm going to start focusing on a bit more as we get closer to that Fed day and as some of the criticism and the discussions between Jerome Powell and also Donald Trump here take place. Trump is supposed to schedule a call with Powell, at least he's thinking about doing it. So we're going to want to watch that CME's Fed Watch tool and see if some of the insiders get some kind of quick knowledge as far as which way interest rates are going to go. Remember, our current rate here is 4.25% to 4.5%, and the next Fed meeting here is May 7th, so about 13 days, and we're seeing about a 6.1% chance, so a slight downtick from yesterday of a 25 basis point interest rate cut. You go out to June 18th, it's a 55.3% chance of a 25 basis point interest rate cut, and a 3.4% chance we'll be down 50 basis points at that time from the current levels to 3.75 to 4%. So looking at the currencies here, you do have the dollar index pulling back about 0.5%. You got the euro currency up about 0.5%. Remember, they're about 60% inversely correlated here. You look at bonds and a 10-year note here. Well, the yield on the 10-year had declined about 4 basis points to about 4.35%. So a little bit of boost in the 10-year note. You got cryptocurrencies under slight pressure here. That comes after yesterday's explosive rally. We saw Bitcoin futures pushing on up close to that 94,000 level, and we're at about 92.5 right now, down about $1,000. Ethereum under a little bit of pressure as well. And if you do note that we are able to trade those Solana futures here, they've got a micro one and they've got a mini one here. I'm seeing the mini get a lot of volume in that market, so that might be something that we're going to start wanting to monitor here going forward. Now, checking on the precious metals overnight, you got gold up 1.5% at 33.4380, so that's up about $50. The low on the session was 33.0130. So call that your pivot level. And then below that, that critical level of support, if you look the way gold had been trading, we had this breakout, we make an all-time high. We struggled right around, remember that 32.0160 to 90, whatever that level was, that was the all-time high. So call that your second level of support, because I think your first level of support is going to be right around 32.65, because it took about 3 sessions before we broke through that to the upside. So if you look at old resistance, now new support. So we didn't quite get low enough here yesterday for me to start ringing people up here and looking to add on to some of those positions. If you look at gold futures, they are up about 25% year to date. So it has been an explosive rally. Now, something we saw yesterday was what? We saw gold futures come off dramatically. We saw silver futures rise quite a bit. And I think that if you look at the dynamics of the way things are, and also there was a Wall Street Journal article that was pointing that, hey, if you miss gold's rally, go for silver instead. Not a recommendation. This is just what the report had said in the article out of the Wall Street Journal. So this is somewhat what we're seeing here, and it started really in yesterday's trading session. We'll see if it continues to get legs, but I thought it was a very informative article for people, and it was quite well written here. I mean, it really dummies down some of the real inner workings of silver and things like that, and the components here of silver, but it did cast its point well, and it's saying that silver's rallies, they tend to follow after a gold lag. So this is likely to do with silver's split personality. So you look at, as a precious metal, it carries much of the weight, much of the appeal as the gold market. It retains some value, especially during times of like inflation and war and unrest and things like that. So you see gold futures push up. You generally see silver futures, they lag because of the catalyst that's pushing gold higher is focused mostly on that, and it kind of only picks some of the strings of the silver market and pulls that forward. Remember, silver, again, it has that split personality because of the fact that it has more industrial uses than gold. Silver is found in electronics, solar panels, making it more economically sensitive. I've discussed many times that if we go into a real recession, and the crap really hits the fan. You think I'm buying 2 new TVs, or do you think I'm gonna bring the old clunkers over here instead? You think I'm gonna go out and buy a new iPhone, a new set of AirPods? All these things have silver in it? I don't think so. I think I'm gonna hunker down, and that takes that industrial demand, that electronic demand, things like that, a little bit off the table. So when markets are starting to fear that downturn, that economic downturn, gold often outshines silver, and that's at least initially. So they talk about the gold-silver ratio, and we've talked about this as well. If you look here yesterday, it did dip down to about 99 to 1, 98 to 1, and we were at 106 earlier in the week. So if you look at the last 30 years, the average has been about 68, and this is according to the article, and they said during the COVID panic in March of 2020 when it reached 113. So I remember that day, long gold, long some silver, gold takes off, silver really breaks with the copper market. Copper sold off dramatically in 2020, and what did I do? I got in my car, I went to the coin shops, and I cleaned them all out, right around $11.76. I posted some of those receipts from all the silver eagles that I was buying at that time until the coin shops wouldn't sell them to me anymore. They said that they're not in the business of losing money, and they've draped sheets over all of their silver and things like that. But that's a whole nother story. You go back during the financial crisis, they say that it rose from 53 in June of 2008 to 80 in November. And then they look at some other performance here. They talk about how silver outperforms. So you got to get this springboard. So you get gold up at these record highs, you get this fear, you get this uncertainty, and what happens here to get gold really outpacing, because during that 2008 financial crisis, and many of you are trading with me today that were trading with me back then, you saw silver futures rose past the crisis 81%, versus gold only rose 44%. It was that springboard that took off. And remember, we peaked in the silver market right around 2011. So what could change on this pattern, or what could create the same similar situation, is that you get two things. You get the springboard, so you get silver already in this kind of new comfortable band between, forget that Sunday night washout, call that 29.25, that triple bottom there, because it did wash out, but it kind of closed and held that level. So you go back into December 29.25, and then you go to that Sunday washout. Where did it settle at? 29.25, and you go up to about $35, where we've been running into some resistance right around now. So this is our new price span that we're in here. So as long as we hold up to this elevated thing, you start to get the Federal Reserve to cut interest rates, you get trade deals to occur, and then you get a cyclical upturn in industrial demand. Remember, the guys that are stacking silver and things like that, it only makes up a small component of silver and only a small percent of the population. So hats off to you that if you own silver and are stacking metals, actually are doing that. Otherwise, most of that demand, the same thing with platinum and palladium, comes from industrial demand, not investment demand. Silver also has solar demand, electronic demand. It's got silverware, things like that really go into the mix here of how things are going. And I'm not going to go out and buy a new silverware set. If we're going into an economic recession, I'll be stealing the plastic forks and knives from all the fast food restaurants. So if you look at things the way they're setting up, I did discuss that I think we're getting past a turning point. Maybe these talks aren't taking place with China yet, but I could see that Trump is getting ready to kind of raise the white flag in certain things. They're already starting to cut deal on auto parts and things like that coming in, or other different aspects of the trade talks, and kind of tapering some of these things down. And that's where you could see things, some light shine into the economy, and we see inflation come down, things like that, and the Fed cuts rates and the cyclical upturn takes place. Now, that's a bit of a discussion on the silver market. getting back to it, looking at the ETF flows, the exchange traded funds, they did cut 33 ounces of gold in the previous session here, and they added 147,000 ounces of silver in that previous session. So you look at the year-to-date percentage change here, and gold up 7.9%, so it's holding steady. And then you look at silver, slight uptick, up 2.5%. The gold-silver ratio, again, Tuesday 106, down to now about 100 to 1 here as of this recording. So something else to note, because this has been quite a bit of a discussion. Many of the people that watch this video and things like that have miners. We use miners in our wealth management company, Blue Line Capital, as well as ETFs and things like that, because it's a securities registered entity, not a futures registered entity. So you look at the miners and things like that, and you'll notice that the world's top gold miner, Newmont, sees the highest cost in a decade. Newmont posted its highest quarterly cost in at least 9 years, in part because one of the operations in Australia's largest mines was really facing a lot of challenges here. But it's the all-in cost of producing the precious metals has hit $1,650 an ounce in the first quarter. That's about 13% more than the prior quarter, and its highest records going back to 2016. So the point that I'm bringing up on this is that yes, gold futures are pushing higher. Yes, silver, yes, copper, and things like that. But the other key components to operating a mine, those costs are also going up as well. And the reality is that when you get to your revenues and you get to your net revenues and things like that, they start to compress here because of the rising costs. So if you're going to trade, if you want to be long gold, silver, copper, buying miners is not necessarily the best way to do it. I think that the pure price play with the futures contract, because of the fact you're doing what you want to do. You want to gain exposure to silver, you're buying the 1,000-ounce silver contract. You want to gain exposure to the gold market, you buy the gold futures contract. You don't necessarily look at these miners, which have a number of different components that could really weigh in, and you could see that underperformance tends to take place here when you do see signs of rising inflation and things like that within the miners. So shifting gears to crude oil, because crude oil is another market that many people trade here with Blue Line Futures. We did see a slight recovery after people monitored OPEC, and OPEC came out here yesterday and said that they perhaps may want to raise supply here in June. So we saw a big sell-off in the crude oil market on that type of note, and now we're seeing somewhat of a recovery with the U.S. equity markets and things like that. If you look at some of the spreads going out, they're starting to tighten a bit as the producers are starting to add crude oil rather than continue to sell crude oil. So there's a shift in the structural dynamic in the oil market right now. If you got any questions, give us a call. I'm going to be splitting out a little bit early out of the office here today. My partner, Bill Baruch, drove down to Florida. We're going to hang out on the beach here, kick back, relax, and share some stories here and a couple cocktails on the beach. So if you got any questions, give us a call. Shoot an email to info@Blue Line Futures. And remember, futures and option trading, it does involve risk of loss, and it may not be suitable to all investors. Good luck, good trading. Go get them.